SCHD was labeled as the king of dividend ETFs for many income investors with a solid dividend yield, consistent dividend growth, and great returns. But recently, it's been underperforming, and a lot of investors have been wondering, is SCHD still worth it? Well, in this video, we're going to talk about what made SCHD such a great dividend ETF in the first place, and what's been going on with this ETF recently to help you decide if you should sell SCHD or if you should keep buying and holding. Let's get right to it. Let's kick it off with what made SCHD become such a popular dividend ETF for so many investors. One of the most important pieces to SCHD is its strategy. SCHD tracks the performance of the Dow Jones US Dividend 100 Index, which focuses on quality companies with a strong history of growing and paying dividends. The companies that SCHD picks go through a variety of filters. This includes having a market cap of at least $500 million, a minimum average daily trading volume of $2 million, and they must have paid dividends consistently for at least 10 years. It also considers different metrics like return on equity, indicated dividend yield, cash flow to total debt, 5-year dividend growth rate, and more. So the SCHD algorithm really works to filter down to providing high-quality dividend stocks, and when you're investing in SCHD, you're investing in this strategy. This filtering allows SCHD to have some pretty amazing dividend growth along with a great yield. Speaking of yield, currently SCHD has a dividend yield of 3.75%, which its dividends are paid out quarterly. SCHD has a 5-year annual dividend growth rate in the double digits of 10.8%, and it's had 13 years of consecutive dividend payments, which its dividends have been growing every single year since it's created, which is pretty incredible. It also has an expense ratio of just 0.06%, and on top of that, SCHD had annual returns of over 11% in the last 10 years and nearly 13% in the last 5 years, which is pretty solid for a dividend fund. SCHD is made up of 103 stocks with top holdings in names like Texas Instruments, Chevron, ConocoPhillips, and others, with exposure to sectors such as energy, consumer staples, healthcare, and more. So it has a pretty nice spread here. But recently, there were some pretty big changes to the sectors and holdings that SCHD is exposed to. So let's get into what were the big changes in 2025. Every year in March, SCHD goes through a process called a reconstitution. And this is when a fund rebalances and reevaluates its holdings based on the ETF's rules and criteria, and to also reflect the changes in the market. In the most recent reconstitution in March, the holdings shifted quite a bit, making things a bit controversial, with some new names added, some that were dropped, and some pretty big sector shifts. So SCHD had dropped 17 stocks that included names like Pfizer, BlackRock, US Bancorp, and others. Which from this chart, if you take a look at the sectors, you can see right away that there's a pretty big chunk of holdings from financials. Jumping over to the additions, SCHD had added 20 stocks, which there's a bit of a mix, although for its weightings, it's primarily energy and consumer staples. If we pull back and take a look at these sector changes at the time of reconstitution, there were some pretty big changes. The exposure to energy had increased quite a lot by 8.8%, consumer staples by 3.7%, and then there are some smaller differences with the other sectors, while healthcare decreased by 2.1%, and then a major cut in financials from 17 to 8%. The increased energy sector exposure definitely raised some eyebrows given the unpredictable nature of the sector and the volatility that can come with it. But is this what caused so many people to change their minds when it comes to SCHD? Next, let's talk about what's going on with SCHD. So if we take a look at the performance of SCHD over the short term, so 1 year, we can see that it has returns of just around 3%, which is including the dividends. And if we zoom in a bit more, year to date for just 2025, so far it's barely hanging in the positive. As many would have hoped, SCHD wasn't as resilient during the market drop earlier this year, along with it not recovering very well. So what happened here? Well, I do think it was a bit unfortunate that SCHD's reconstitution was on March 21st, and very soon after that, on April 2nd, we had new tariffs announced, aka Liberation Day. The broad market as a whole faced a huge sell-off along with SCHD, and while there has been some rebound, it's fallen short compared to other dividend ETFs. and the increased exposure to energy really didn't work in SCHD's favor. It also doesn't help that some of the largest sectors in SCHD, like energy and healthcare, have not been doing that great over this past year. I see these same sectors in energy and healthcare being a possible issue as well in the near future for SCHD, which could cause it to continue to drag out in performance. Now, there was a bit of a rally in oil prices during the recent Middle East conflict, but since the ceasefire in late June, there's been a lot less panicking in the energy markets. And since OPEC Plus is set to accelerate oil output, so increasing the supply of oil in the market, this is likely to weaken the price of oil and lower demand, which in turn will have a negative effect on some of the energy companies that make up a pretty big percentage of SCHD's holdings. Also, there are some possible political headwinds for healthcare depending on the potential impact of price controls, tariffs, or new legislation on drug and biotech stocks, which SCHD has some large holdings in. One last thing to consider is that SCHD doesn't have heavy tech exposure, as it's very much so value tilted, which right now tech is back on a run and it's one of the best performing sectors since the market's been recovering, and SCHD is not benefiting from that at all like some other funds are. Now, these issues don't mean SCHD is doomed forever or that it's a bad investment, since every fund has its risks and weaknesses, and things will depend on market conditions. But I do believe that it is in a slight rough patch, but that doesn't take away the fact that it's still a solid fund. Next up, let's talk about some great dividend ETFs that are alternative options for SCHD. Since SCHD has been the golden child of dividend ETFs, it'll always be compared to any other ETFs that pay dividends. And since SCHD is in this rough patch, there's quite a few investors that are looking to jump ship. So for that reason, I just wanted to show and compare SCHD to a few other popular alternative dividend ETFs and explain the differences. Now here's a list of some different dividend ETFs that you can come back and take a look at later on, and I included some higher yielding covered call ETFs. So the three ETFs I wanted to talk about are all a bit different from each other in SCHD and their strategy and holdings. So first we have DGRO, the iShares Core Dividend Growth ETF, which focuses on stocks that have a history of consistently growing dividends. Then VYM, the Vanguard High Dividend Yield ETF, which holds companies that offer high dividend yields. And then SPYI, the NEOS S&P 500 High Income ETF, which is a type of covered call ETF that is focused on providing high monthly income through S&P 500 exposure. Now let's break down what makes up these funds. DGRO holds around 405 stocks, and it has top holdings in names like ExxonMobil, JPMorgan Chase, Microsoft, and Apple. And its top sectors are financials, technology, and healthcare. Keep in mind, this fund is a much more tech-leaning dividend fund than SCHD. VYM contains about 591 holdings, with top holdings in Broadcom, JPMorgan Chase, Exxon, and Walmart. Its top sectors are financials, technology, consumer staples, and healthcare. This fund is a much more broad ETF than SCHD, and it isn't as refined to the level that SCHD is with its dividend stock selection. Last, we have SPYI, which has 511 holdings, with top holdings in names like Nvidia, Microsoft, Amazon, Meta, and Google. And its top sectors are in technology, financials, and consumer staples. This fund combines S&P 500 exposure with a call option strategy, so its holdings will reflect that of an S&P 500 fund. So you can see there's quite the variation between all these holdings in SCHD. For one, they all have more holdings than SCHD, making them a bit more diversified. And if you didn't catch it, they also have more tech concentration, with SPYI having a much bigger difference. For the dividends, DGRO has a dividend yield of 2.2% with 10 years of consecutive dividend growth. VYM has a dividend yield of 2.6% with 14 years of consecutive dividend growth, and SPYI in the double digits with 12.12% and 2 years of dividend growth. But this fund isn't about growing dividends. SCHD is still very competitive when it comes to its dividends and dividend growth. Now, SPYI is very different compared to the other funds since it's a covered call ETF, so its focus is solely on income with possible appreciation. Now, I don't have time to go into detail, but I'll link in the description below my SCHD versus JEPQ video that explains everything you need to know about these covered call ETFs. Next, I want to jump over to the performance of these ETFs since that's what everyone really cares about. So if we move over to the chart, taking a look at the past year, we can see that SCHD kind of got left behind compared to the other funds. And it's pretty easy to see the real gap occurred after the big dip from tariffs, which SCHD is not rebounding anywhere near the pace of the other funds. Jumping back 3 years, it's still slightly lagging behind. And 5 years out, it closes in much more, where SCHD was actually the best performer until the drop in April. Oh, and since SPYI is barely 3 years old, I didn't bother putting it up there. So while these are all dividend ETFs, they perform quite differently from each other. They each have different strategies and vary in their holdings. SCHD is pretty narrow in its holdings, considering it's just large cap value stocks, while these other funds have more holdings and the added benefit of having more tech and growth exposure, which have really been working in their favor. Is it time to drop SCHD, or should you hold or buy? I believe there are a few things to consider if you're unsure about what to do when it comes to SCHD. I think the most important thing to keep in mind when it comes to investing in SCHD is that your conviction in this ETF should be in its strategy and not just its holdings. The SCHD algorithm has very specific filtering that picks high quality dividend stocks from the results of its selection criteria, and this is what you're investing in when you buy the fund. Now, the trade-off to its strategy is that when SCHD has stocks that are performing really well and their share prices are going up, then the dividend yields of those stocks are going to decrease, and in turn, they'll end up getting filtered out, removing the ability for SCHD to benefit from future potential growth from stocks that may fly high. Now, since SCHD was considered the king of dividend ETFs for some time, it's been compared to just about every type of dividend or income-paying ETF. But it's important to be aware of the differences in function and strategy of different ETFs so you're able to group those that are similar and make even comparisons. SCHD is a large cap value ETF. It's not going to compete with the likes of growth or growth-oriented funds, nor will it beat the double-digit yields of covered call ETFs that have the goal of providing high income. It's supposed to be a piece of the puzzle for building a well-rounded portfolio. While SCHD has underperformed recently, investors shouldn't give up all hope. The short-term performance has been a bit rough, but over the long term, it's provided double-digit returns through different periods of the market, along with managing a solid and consistent dividend growth. You're investing in the strategy of SCHD as it's doing exactly what it should be doing, and it's done pretty well since inception. But if the strategy of SCHD doesn't fall in line with your investing goals and strategy, then there's nothing wrong with that. If you want high growth potential or high income payouts, then you should be looking at funds that have strategies that are geared towards those things instead. If you want to learn about some other great dividend ETFs that could outperform SCHD, then take a look at this video here. Or if you want to see how SCHD compares to one of the best monthly dividend ETFs on the market, then check out this video here. And if you enjoyed the video, be sure to hit the like button and subscribe. Thank you for watching, and I'll see you soon.